During rallies, investors only see opportunities and are blind to the risks. During sell-offs, investors only see risks and are blind to opportunities. While the S&P is barely down 2% from its all-time high, many popular stocks are down 75%, 56%, 49%. Archer is down 43%, Ouster is down 41%. There's a lot of stocks that are popular and they're down much more than 2 or 3%. But even the big seven guys are down much more than 2 or 3% from their all-time high. And for me personally, I believe we will likely go lower, but I'm getting excited that I can buy many more stocks at a much lower price. And for me, I'm looking mainly at the big seven to get more exposure to them, as I don't have enough exposure, and Mr. Market giving me another chance to potentially buy those stocks on those sell-offs. And it's like a cheat code for making money, where those big seven stocks, they're not going anywhere, and they go down for all kind of temporary reasons, and then you could avoid the noise and buy them, and you're gonna likely make money over the next 5 to 10 years. But I'm also looking at a lot of the growth stocks that are selling off 50, 60, 70% in case I can find my Robinhood 2.0 that I bought in April, and I did really well on it. And normally in every sell-off, I tend to buy one new growth stock, and it tends to do well. But this is what I'm looking into. Now, the first stocks that I'm looking to buy over the next 30 days is Meta. Meta is down 14% on the months. I did a video on it at 650, but I told you guys if the AI fears continue, it could potentially go to 550, and it seems like it's on its way there, and I personally like it. But Meta is the cheapest of the big seven by far at 20 times earnings. Google is second at 26, then Microsoft at 30, and we have Tesla, which is only trading at 197 times forward earnings. But for Meta in general, it's over $1 trillion company, and they're still growing revenues 26% on the quarter. This is absolutely insane, guys. I mean, there was a time when I used to believe that if the company is too big, there's no way they can sustain 15, 20% revenues, that you have Meta growing much faster than the big seven, and it's the cheapest, and it's over $1 trillion market cap, growing 26%. To me, it's really astonishing. Now, in terms of Meta in general, they have access to 3.5 billion people every single day. And I think this is really not priced in the stock, you could say, at 20 times earnings. I mean, look how they launched the Threads app. They launched it out of nowhere. They can advertise it for free to 3.5 billion people. Everyone wants to advertise on Facebook and Instagram, but if Meta itself wants to advertise its own product, they could do it to 3.5 billion people overnight for pretty much no cost. This is absolutely crazy, and it's not priced in at 20 times earnings. Expenses as a percentage of revenue, they've been disciplined so far, which is why the market has been rewarding Meta. But this is about to change again next year in 2026. But even now, CapEx has more than doubled, and it's expected to increase in a major way in 2026. The analysts, or I should say the management team, they said that our current expectation is that CapEx dollar growth will be notably larger in 2026 versus 2025. We also estimate that total expenses will grow at a significantly faster pace or percentage rate in 2026 versus 2025 due to AI talent and other kind of technical talent. And the market believes that this is another metaverse moment where Meta is just wasting money and it's really not going to benefit from it in general. But the numbers prove otherwise. If we look at what Meta did in 2022 when the stock declined a lot, they were spending 62% of their operating cash flow on CapEx. Now they're spending 58%, and next year they could potentially spend maybe 60 to 65%, could be a little bit more. But they did spend 62% on CapEx. Now let's see what kind of returns they got from that, or let's see how Meta grew in general after they spent so much on CapEx. If you look at the revenue growth, it has massively re-accelerated from 2022 bottom. It was growing in revenues 23%, 24%, 27%, and 2 years later, almost 3 years later, it's still growing at 26%. So don't you believe that some of this growth was due to the Meta CapEx investments that were boosting organic growth and boosting, AI ads and things in general? Maybe the metaverse was a problem and they lost some money on that, but everything else was very, very efficient. So Meta has proven many times that they are spending on CapEx and they seeing results from it. But if they want to pull back the capex, they could do it anytime. So this is not like the core business is damaged. It's not like people will stop using WhatsApp or Facebook or Instagram. None of those things. This is just the money spending on capex. They can reverse it next year and say we're gonna spend 80% of our operating cash flow on buybacks. The stock would go up a lot, but that would not be good for the long-term growth of the company. So the company is thinking for the long term, and analysts are thinking for the short term. But Mark Zuckerberg kind of knows that, and he learned his lesson from the metaverse in 2022. And you could tell from the way he talks, where he's talking about the best case scenario and talking about the worst case scenario. And this is what he said. He said, we're also building what we expect to be an industry-leading amount of compute. Now there's a range of timelines for when people think that we're going to get super intelligence. Some people think that we'll get it in a few years, others think 5 to 7 years or longer. I think that the right strategy is to aggressively front-load building capacity so that way we're prepared for the most optimistic case scenario. Now, if it takes longer, then we'll use the extra compute that they built to accelerate our core business, which continues to be able to profitably use much more compute than we've been able to throw at it. And in the worst case scenario, we're just slowly building new infrastructure for some period while we grow into what we build. So none of those things that they're spending on buildings and infrastructure and the amount of compute is like going to waste. This is not the metaverse. It's not Fartcoin or anything crazy. This is something that the company will use for super intelligence. And if it takes a long time or if it never comes in and they can't do anything with it, they're front loading it now, which means the next years after 2026, they're going to be less capex intensive and the company is going to grow into it. So none of it is going to waste. And this is a massive overreaction from the market. Now, if we look at where Meta is trading at, it's trading at 20 times earnings. 20 times earnings for 3.5 billion people every single day, and WhatsApp and Instagram and Facebook and the potential and a founder CEO. To me, this is really, really cheap. It's really cheap, guys. And I know some talks about, Meta overstating their earnings by 10 or 20%. But what would that be? Like a 22 forward PE ratio? The stock is still cheap. It's very cheap, in my opinion, for the revenue growth and everything that the company is doing. And by the way, I'm using Fiscal.AI to come up with those charts. So if you want to try it out, they give you 2 weeks of free access if you use my link into the description. But I believe Meta is the cheapest of the big seven. This is a stock that I want to own, and I want to buy more of it as the stock goes down. Hopefully we get 550 or you could say 19 times earnings, then I would have to buy a lot of the stock personally. But the second one that I like very much, and I own a lot of it, but I don't own enough, is Amazon. Amazon is down 5.5% over the last 5 days, and I'm very happy for that because, again, I did not own enough while going into the earnings report. The earnings report was amazing, and I said I wish I bought more, but now, you don't have to wish anymore because the stock is going down as a lot of short-term focus is in the market, and to me, this is a good opportunity to take advantage of. And I spoke about this many times, but I believe the robotics business of Amazon is underrated in terms of the efficiencies that they can find, but also if they ever license this technology to maybe other players or around the world, they could, they could be like another Amazon Web Services kind of business that came out of nowhere and generate billions and billions in revenue and even recurring revenue for Amazon. But Amazon is hoping that the robots can replace more than 600,000 jobs it would otherwise have to hire in the United States by 2033. So this is a longer term goal, but Amazon is already seeing the efficiency of that as their gross margins have more than doubled from 22% in 2011 to 50%. Some of it was due to Amazon Web Services growing so much. It's a higher margin business, but it also has to do with the robotics, making Amazon much more efficient. And Amazon is still working on this technology, This is one of them. I believe it's called Dave, like Dave Robot or whatever the name is. But this is a robot they're working on, and they're working on a lot of prototypes, and they just keep on improving this technology. And the facility currently has 4,000 workers. But once the robotic systems that they're working on are installed, it is projected to process 10% more items, but needs as many as 1,200 fewer employees. So you can see the massive efficiency with that, where they can boost volumes, boost production, and also reduce expenses from the robots that they're building. And again, the future of that is amazing, and none of it is priced in. Now, my favorite part about Amazon, and the reason why I like it so much, is because they don't do buybacks and they don't do dividends. Returning value to shareholders is amazing, but it's not really as amazing as the company being able to reinvest in itself so much, widen their moat, widen their competitive advantage, and boost organic growth over the very long term. And this is what Amazon is doing. And this is a chart that I think is underrated, which is the total square footage of Amazon, which is almost 769, I believe, million square feet, which is growing every year. And they invest in real estate, and they invest in more logistic capacity, which is why now in 2025, Amazon Logistics has overtaken FedEx, UPS, and it's about to overtake USPS, in my opinion, by volume growth over the next 2 to 3 years. And this is a physical moat that AI cannot disrupt, and no one can disrupt this physical moat. Now, if I look at how much I'm paying for all of that, I'm paying 14 times price to operating cash flow. 14 times is extremely undervalued for a company like Amazon that's growing and is expected to keep growing. Their operating cash flow, 21%, 20%. So I'm paying less than 1 times price to operating cash flow growth. And I love using operating cash flow because the company, as I told you, they're reinvesting in themselves a lot. Most of it is not in maintenance capex, it is in gross capex. And if the company pulls back on it, it's going to be much more profitable, or it's going to be much cheaper, I should say, on a price to free cash flow basis, which is why I use operating cash flow. And I think the company is still very cheap. I think the robotics business is not priced in. And this is a stock that I want to own more of it, especially if it goes below 220. And I like Meta also. And I'm looking at a lot of growth stocks as a potential Robinhood 2.0, you could say. And if you want to find out more about what I do and things that I buy and I sell everything I do in my own group. This is the link if you're interested. But thank you again for watching. Not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.